Hello traders and investors, Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, we got a very nice bounce recovery here on the S&P and the QQQs. The S&P putting some distance between us and the most recent support level, trying to establish the daily uptrends, and the same thing can be said about the QQQs, breaching above our recent area of resistance, which was 612 down about 605, putting in a little bit of a daily uptrend of their own. So, is the selling panic finished? Are we ready to mount towards new all-time highs, or is it just a bull trap and will we be sent to more lows? Additionally, we have some big earnings to cover today as well, especially in terms of that NVIDIA release, right? So in today's video, very simple, guys. Number one, we will be going over the NVIDIA earnings print and derive whether or not NVIDIA is still a good investment, or is it just too big right now? Can we still make some good ROI, or are the numbers just not compelling anymore? After that, we will get into our regular technical analysis rundown of our major market indexes, take a look on the rotation between the SPY, the Qs, and all of our minor sectors, see how the rotation is taking shape. Thereafter, we will get into our big tech names as well. Some of these names had very nice recoveries from their most recent lows. We will derive whether or not these are still investable names, or whether or not we should stay away because of all the CapEx spend, all the AI fears, etc., etc. And then at the very end of the video, of course, we will take a look at our biggest gainers and losers. We'll spend some time talking about the themes that we discussed in yesterday's video, but also many times over the past month and a half, and we'll kind of pick apart some of the names here that could be very interesting to take advantage of those themes once again. We touched upon them yesterday, but just to build upon that and kind of cover them a bit more frequently, just so you guys know what to look for into 2026. But not only 2026, these themes that we keep discussing, guys, are going to be ongoing themes for 2026, 27, even into 2028, as they're seeing heavy capital inflows, whether that's anything from military spending to energy to AI infrastructure itself, not the hyperscalers, no, everything that goes inside of the data center and inside of the chip and wafer manufacturing. So we'll take a look at that at the end of the video. So it should be a very fun one. Probably a lot shorter than yesterday's video. Hope you guys enjoyed yesterday's video, by the way. Let's get right into it, shall we? So the S&P up 0.84, the Qs up 1.45%. Very decent day and decent market breadth. However, you had a bit of a rotation back to tech. So you'll notice that the top quadrant of the market and financials, very healthy. And that's what I was saying. If you really want to see SPY expand, you're going to need 2 out of the 3 biggest sectors in the market to actually provide some lift. And that was QQQ, XLF, or healthcare, right? 2 out of 3 is what was needed, and 2 out of 3 is what we got today. Nice move on the QQQ, everything from semiconductors, even software catching a bid, big tech performing very well today into those NVIDIA earnings, and the banks, XLF, doing really well. Credit cards, the banks, and several components of XLF doing very well today. What didn't do well today is the bottom half of the market, but let's be honest, they deserve a little bit of a breather, right? After carrying the market seemingly since the very beginning of January, they had a nice little pullback day today, so once again, as we were saying in yesterday's video and many videos prior, pay attention to some of these pullbacks, especially in industrials and utilities and even XLP, right? You are going to be looking for them to eventually set some higher lows after these very big breakouts. If you do find some higher low opportunities on all these sectors, either XLP or XLI, right, looking into it, that is going to be a nice re-entry opportunity, whether you're playing these as ETFs or whether you're playing these as individual names. So keep that in mind. On your one-day relative, you can see that rotation back to tech even better. Financials, tech, communication services, which is largely Google, Meta, and Netflix. Utilities, basic materials, and cyclicals higher. The ones that were down, well, they are the best performers of the year so far, so deserve a little bit of a breather. Energy, real estate, industrials, and defensives. And now, with the 1 week relative performance, even though the bottom half of the market was lagging a little bit behind, we've got more sectors in the green. Technology finally making its way up there, so most of the market indeed is in the green. Decent rotation, right? Everything is kind of just normalizing right now. Is it going to just be a one-day thing, or are we going to see more of this? Well, I do believe that the market is overall healthy, right? You had some big participation from the bottom half of the market to start off the year. If we can get big tech, I mean, semiconductors, they've been strong all year so far, let's be honest, right? But if you can get big tech and a little bit of mean reversion in software and financials to start participating, and additionally, if you get the X factor, the XLV kicker here, if they can break the range and move higher, should be looking pretty good for the S&P overall. So keep all of that in mind when you're analyzing all of these rotations in the market. Fear and greed index right now still remains at a bit of a neutral standpoint, as we are still very flat in relation to where we are in relation to the S&P and the 125-day moving average right there. Stock price strength is still at extreme greed in terms of net new 52-week highs and lows. The market is very broad. I showed you a statistic yesterday saying 60% of stocks in the S&P are beating the actual index. Of course, there's a lot of dispersion, right? Meaning that there are a lot of names beating the index by a very large amount, and then there's a lot of names that are underperforming the index by also an equally large amount. So many names are red on the year, anywhere from 40, 30, mid-20s percentage points. A lot of those having to do with the initial software sell-off that we've been seeing accelerate here over the past few weeks. So that being said, before we get into more technical analysis, guys, let us get into the big boy of the group, right? The good old NVIDIA earnings. And we know that NVIDIA just hasn't been the same in terms of reporting earnings since about 2024. You guys might remember there was a period in time where NVIDIA would move up, 10, 15% after earnings. That hasn't happened for a while. As a matter of fact, the average earnings move in the last 4 quarters has been about 3% up or down the day after earnings. So that being said, we were coming into today's earnings knowing that big tech was spending a whole bunch of money on CapEx and that it was probably going to translate into massive amounts of revenue and great guidance for NVIDIA. And that's exactly what happened. However, true to the algo fashion that we've been seeing over the past few weeks and past few months, arguably, especially in these Q4 earnings releases, right? The stock didn't move. We're basically flat in the after hours. It popped up 3-4% as soon as the print was released and then slowly faded, but nothing was bad in these earnings. Not the actual earnings print, not the guidance, and definitely not commentary by Jensen Huang. All of that was very bullish, pointing to the fact that the AI trade is still very well alive and still, surprisingly to most, in its initial legs right now. So moving on to the actual earnings numbers, 5.5% beat on EPS and a 3% beat on revenue, beating revenue by about $2 billion. Which is not easy to do, right? $2 billion in relation to 68 might not sound like a lot, but it is a considerable amount. If you take a look at the numbers real quick on the screen, you will see that just the sheer size of the prints here, right? Total revenues were up 73% year over year. This company is re-accelerating revenues. Initially, about last year, it went from 60 to the mid 50s, and now they're re-accelerating to the high 60s, and even now 70 in the Q4 print, 73%, 75% data center revenue year over year. That was also a beat on the estimates. The only divisions that didn't perform too well was gaming and AI PCs, as there's a little bit of, supply shortages that NVIDIA is currently facing. Obviously, a lot of the chip manufacturers and memory manufacturers are favoring the AI commercial buildouts rather than, consumer cards and whatnot. So that division was a little bit slow, but overall, guys, it's still a very small component of the business, right? But just to say, right, the earnings report was not perfect. I mean, by not perfect, I mean, sure, AI and gaming PCs, they missed. Auto and robotics missed slightly, but it's a very small division. And OEM and other also missed. But they're a fraction of the revenue that the company brings in. Most of the attention was obviously focused on data centers, and they absolutely crushed it. Pro visualization actually came in at a very nice beat, 159% year over year. But you can see, 85+% of all revenues for NVIDIA do come from the data center division, so that's what we should be focusing on. Gross income was also a beat by about 4%, 77% year over year. So not only is the company putting up massive amounts of revenue, but they're continuously increasing the profitability as well. Gross margins now up to 75.2%, which is insane. Operating income as well, beat by 4%. That was up 81% year over year, so growing faster than the revenues. That's operating leverage, right? When they scale more and more, they're actually getting more and more profitable in the process. Your operating margins, 67.7%. You'd be hard-pressed to find many companies out there generating these amount of operating margins overall. Last year, 64.9. So clear upticks right there. EPS was also a beat, and free cash flow. Look at the amount of free cash flow that this company is bringing in. $34.9 billion. Not many companies on the planet are able to generate that amount of free cash flow. That's an increase of 124% year over year. Last year, for example, in this same quarter, $15.5 billion. Was the free cash flow print. Now, 34.9. It's absolutely ridiculous numbers by NVIDIA. And here's the guidance all the way down below. Q1 revenue, they're supposed to come in at $71 billion. They beat it by 10%. And I wouldn't be surprised if they beat the raised guidance as well coming into next quarter. That is 77% revenue guidance year over year for Q1. So even better than we had in Q4, which is absolutely ridiculous in my opinion. Gross margin will stay put at about 75%. And operating incomes, obviously you raise the revenue, you're going to raise the operating incomes as well, up by about 6%. Such fantastic numbers by this company overall. Now, moving on a little bit further here in terms of the quarterly revenues by trend, you can see data centers is definitely not the issue. Gaming has pretty much stalled, right? They had some nice upticks into the beginning of, 4 quarters ago, essentially, but they kind of peaked out Q2 and Q3 and then coming down into Q4. So gaming we'll have to pay attention to moving forward, but Jensen did say on the call that they do expect a few bottlenecks to persist over the course of the first half of 2026, but it should free up by the end of this year overall. Professional visualization, making good progress right there. Auto with their NVIDIA drive system and whatnot, they're driving revenues here, but it's still not accelerating in a massively rapid fashion, but sequentially quarter over quarter, there's definitely no problems to notice here whatsoever. And OEM and other also is just kind of chugging along down there at about $161 million for the quarter. Not too bad, but overall, guys, this revenue profile is very good. It's just the gaming segment that you kind of got to watch and pay attention to because of some of those supply bottlenecks, because a lot of these companies are just driving all of their available capacity towards the AI trend and kind of disfavoring the consumer side of the business as for right now, right? But then again, consumer electronics demand hasn't been super high in the last 2-3 years, so it's understandable why they're doing that. They're catering to the segment of their business that has the highest demand, and the segment of the business that doesn't have the greatest demand, well, they're kind of tapering back, right? Just reallocation of a bit of resources right there, but still something to pay attention to. Speaking about those data center revenues, compute was a big revenue driver, of course, but networking as well. Strong adoption of NVLink, Spectrum X, and InfiniBand. If you guys don't know what NVLink is, it is the basically link between the different GPUs, which allows you to put so many GPUs in a rack and be able to talk to each other very well. So not only does NVIDIA say, here's a bunch of GPUs, they also offer the NVLink and Spectrum X to help people network all those cards together. Basically, they want to ship AI factories, not just give the clients cards and say, here, deal with the cards, right? No, they want to provide end-to-end solutions, and that has to do with the compute, the networking, but also the software, because obviously we know that one of NVIDIA's true moats is the CUDA software ecosystem. So keep that in mind as well. Some quotes here from Jensen Huang in terms of the $3 to $4 trillion in data center capex by 2030. Here's what he had to say, right, in terms of the sustainability of where they're going with all this capex. Let's reason through it. On first principles, the way that software is done in the future is token driven. Token generation is at the center of almost everything that relates to software in the future and relates to computing. The world was investing about $300 to $400 billion a year in classical computing. Now AI is here. The amount of computation necessary is 1,000 times higher. The compute demand is just a lot higher. The amount of token generation capability that the world needs is a lot more than $700 billion, which is the current outlay of capex by all the hyperscalers for 2026. We're going to continue to invest in compute capacity from this point out because every single company depends on software. Every software will depend on AI, and so every company will produce tokens. That's the reason why I call them AI factories. The way we used to do software was pre-recorded, but now everything is generative in real time. It can take into context the person, the situation, the query, and the intentions. The amount of computation necessary is far, far greater than we used to do software in the past. So basically saying as well, hinting at the fact that agentic AI has turned an inflection point. It literally happened in the last couple 2 to 3 months. The world is now awakened to the agentic AI inflection. The agents are super smart, solving real problems. And this has to do with all the Claude releases, the Gemini releases, the OpenAI releases in terms of agentic AI that we've been talking about here on the channel in the past 2-3 months. The reason that I titled the video, yesterday's video, "The Market is Changing," is because of all these AI agents. That is what's ripped the software name so far, right? Last year was all about LLMs and chatbots, simple queries. Now, right now we're talking about inference and agentic AI. That has been the actual thing that's really been changing the market dynamics, changing the landscape, and that is exactly what requires so much more compute. When you just prompt a little chatbot here for replies, yes, it generates an amount of tokens. It consumes an amount of tokens. When you program agents to fulfill tasks, repetitive tasks, or perpetual tasks on an ongoing basis, the consumption of compute is far larger. And so this is now the second wave. Obviously, the third wave of AI is physical AI with robotics and things of that nature, right? And we talk about that briefly on the channel. China's been making some tremendous strides in that overall. Tesla has been making some pretty good strides too. with some companies like Figure in the US also making some pretty good strides. But for now, the market is focused on the agentic AI layer. And more as we move through the next 2 years, more and more focus will be placed on physical AI, specifically robotics, right? So please keep that in mind. But Jensen's comments, I mean, this is just one excerpt, but he talked about a lot about software. He did say that the, paraphrasing here, but the software sell-off was kind of overdone because a lot of these companies will be using AI and not only generating but consuming a whole bunch of tokens as well. So not easy to replace the software layer, all things considered, right? Now moving a little bit forward here too, what is the biggest bottlenecks in AI? I found this to be a very nice piece right here. What is the biggest bottleneck in AI? Since you know that we've been talking about bottlenecks now for the past month and a half, which is was part of the key themes that we've been talking about on the channel, right? Whether it's energy, whether it's copper. Now talking about fiber optics, right? A whole suite of bottlenecks right now in the markets, namely energy. So here's what the lead CEOs over the course of the past month or two, this is what they've had to say where the biggest bottlenecks in AI were, right? Jensen, power generation and grid capacity. Lip-Bu Tan of Intel, memory shortage, specifically high bandwidth memory, another bottleneck, which has led to incredible gains in SanDisk, Micron, WDC, SK Hynix, and Samsung. Lisa Su from AMD, scaling massive data centers within power limits. Once again, energy. Elon, the electrical grid growing too slowly. Satya from Microsoft, fully permitted buildings with power connected. Mark Zuckerberg, securing raw power before competitors do. Andy Jassy of Amazon, decade-long wait times for grid connections. Sundar of Google, local building permits and a lack of electricians. Michael Dell, customers lacking office power and liquid cooling. Larry Ellison of Oracle, the need for gigawatt-scale power plants. And CC Wei of TSM, sold out machines for advanced chip packaging. So there are your bottlenecks, referencing memory, referencing semiconductor equipment, which is why so many semiconductor equipment manufacturers have been doing very well, talking about the ASMLs, the LRCXs, the AMATs, KLAC, et cetera, et cetera. And you can go down the food chain, Amcor for packaging, stuff like that, right? And of course, energy. You notice how many CEOs here are talking about energy, which is why we've been focused so heavily on the energy trade on the channel here over the past month and a half, 2 months, right? Talking about solar and battery energy storage, talking about the independent power producers, talking about utilities to begin with, right? That is probably going to be my favorite trade this year, as it is a trade that extends over not only this year, but over the next 2, 3, 4 years. So we're still early. We know there's not enough power to go around, and the AI trade is nowhere close to being finished. This is like a 4 or 5 year thesis, guys, at least, right? So please keep that in mind when you're thinking about the bottlenecks and when you're thinking about where this CapEx is, well, what this CapEx is doing right now, what phase of AI we're currently in, and what will be the future bottlenecks, right? If you want to make a lot of money in the markets, guys, you kind of got to have to, especially if you're a growth and momentum investor, right? The money is not going to be made from bidding a whole bunch of mega cap companies, although we talk about those many times on the channel, right? The big money, if you have a higher risk tolerance and you're willing to put in the work and willing to put in the research, the big money is going to be made taking a lot of these bottleneck trades, right? Instead of just, focusing on legacy software companies like ServiceNow and CRM and Adobe that have possibly sold off, right? Those can have mean reversions. But if you want to know where the big money, the institutional money is possibly going to go and is going right now, I mean, you just got to focus on these, right? They're telling you where the money is. All the CEOs, the best guys on the planet, right? They're telling you exactly where the money will be flowing here. So pay attention to that. Now that was a little bit of a segue away from NVIDIA earnings, but just to recap the valuation here, because it's all, it all comes into play. NVIDIA is like the master, it's like the primary source, right? And then everything comes under it. If NVIDIA is guiding for higher, you know that TSM is going to be guiding for higher because of the order flow. You know that ASML is going to get more orders. LRCX, AMAT, the semiconductor equipment manufacturers are going to get more orders. That's more memory, more copper, also more fiber optics, more cooling systems for Vertiv, more energy deployed. That has to be deployed from the grid, right? Whether that's through uranium or through legacy fossil fuels like midstream pipelines, in terms of, fuel cell conversion technology with turbines like GE Vernova and Bloom Energy and things like that, right? There's just so much, guys, but it all starts with NVIDIA at the top, because they have all the order flow, they have all the demand, and they know exactly how many tokens will be generated overall into the future, generating these AI factories with that $3 to $4 trillion data center opportunity by 2030. So hopefully all of that makes sense, and which is why I spend a decent amount of time talking about these NVIDIA earnings, and not only talking about the NVIDIA numbers, but also how the entire ecosystem has to be constructed, right? In terms of if you want to find some real alpha across the market and just not bid your traditional, making money here in the next 2-3 years, guys, it's not going to be as simple as just because it's an industrial revolution, right? It's a big revolution, a multi-year revolution, and it's underway. Whether you like it or not, it is coming, right? So instead of bidding, the food companies like Chipotle and whatnot that have sold off, or the Nikes, the consumer cyclicals, like those will come back. The consumers will come back eventually, right? But those are all the conceptually easy trades that everybody is used to, right? Even the Googles, the Amazons of the world, like those are conceptually easy, but they're trillion-dollar companies, right? So that is not where the alpha is in the next 2, 3, 4, 5 years. If you really want to have the true alpha, guys, you got to put in a bit more work. I will obviously help you guys with it as much as possible on the channel to bring you new ideas and new names and new themes and whatnot, right? But, just to say that if you really want to make a whole bunch of money, you got to put in the work to understand how these sectors work. I'm not a semiconductor engineer by any metric, I'm also not a mining engineer, right? Like I don't know the ins and the outs of as much as the next person of the copper industry or the uranium industry and how the supply and demand chains work through there, or utility grid scale power, right? Like I'm not a structural electrical engineer to tell you guys, but I have to put in the work, right? Every single night for an hour or two, I'm learning about, how different independent power producers are tied into the grid. How the kilowatt, what are the costs per kilowatt hour, and how are they derived? How does Google and Amazon circumvent the grid and get their own preferential pricing, right? What companies are in there? Where are all the data centers in the United States, aka, so if you know where the data centers are, what utility companies have service towards those areas, right? Learning more about the solar industry and how lithium ion battery technology actually works. How much is it scalable? How much do they need, right? Semiconductor equipment, right? If you don't know much about wafers, or you don't know much about silicon, or much about, whatever it is, right? All of these things require a lot of research, and it's not easy for most people, right? That is not the easy trade. The easy trade is saying, well, Disney's undervalued on a price to earnings basis, or Nike's undervalued in relation to its previous price to earnings, or, Chipotle may have seen the worst of its sell-off so far, and it's just an easy food company to get behind. Like, sure, they may have some upside, guys, but you won't have the light, or things like that, right? Not saying that I actually caught this one early, but there's a whole host of other themes and other sectors, especially in companies between the, $2-3 billion to $20 billion range, that are all getting a whole bunch of money through these second order layer build outs, whether it's energy or connectivity within the data center, but it all starts with NVIDIA. The reason why it all starts with NVIDIA is because if NVIDIA's growth starts slowing down, if the order starts slowing down, if the CapEx starts slowing down, what do you think is going to happen to all those trades under it? Well, obviously, they're not going to work, right? If everything goes down in NVIDIA, that's the end of SanDisk, that's the end of the Micron trade, that's the end of, you know what I mean? Like, you need to see what NVIDIA is doing, which is why I spend so much time on this company. Not saying if you buy NVIDIA here, you're guaranteed to make a 2x in the next 12 months. It's a $5 trillion company. Obviously, it's not going to happen. But what you do want to see is them continuously increase revenue, continuously push the boundaries of technology, have relentless demand, and in the whole process generate a ton of net margins and a ton of free cash flow so that they can reinvest in either their business or reinvest in other side bets, such as they've been doing, such as in CoreWeave, such as in, Synopsys and things of that nature, right? They're telling you what's going on here, so you got to pay attention to these NVIDIA earnings prints. So hopefully all of that makes sense, guys. Moving on to the valuation of NVIDIA at $195. It is a 24.75 forward price to earnings. This EPS estimate is probably light. It probably will be revised by analysts over the next few days, so I may have to revise this one, but as it currently stands, it's still cheap at about 24 times forward earnings for 2026. Their growth rates through 2027 at 23% a pop gives you a 1.08 peg. Price to sales at 14 is a little bit high, but arguably they do deserve it. because of their position in the market, and free cash flow yield of about 2%. They do have about $62.5 billion of cash on the balance sheet and $58.8 billion of shares in buybacks remaining. Although that's not a very large amount in relation to their $4.7 trillion market cap, it just goes to show that they are doing some form of capital returns to shareholders, right? So that being said, phenomenal earnings by NVIDIA. Even though the stock price didn't go up, that's not what the focus should be on. The focus should be on how early are we still in the AI trade, and you are still very early, right? You should be using NVIDIA as a barometer for the entire AI trade for the demand side of things, right? So try not to focus too much on the fact that, oh, they printed phenomenal earnings, but the stock is flat in the after hours. That should not be the takeaway. If that's your takeaway, that the level of thinking is not deep enough. You have to go deeper, right? What NVIDIA just said is they just guaranteed that all the sectors that I talked about 2-3 minutes ago have a massive runway over the next 2, 3, 4 years, right? That is what we're focusing on, because to move a $4.7 trillion company, it's not so easy. That being said, I do still have shares in NVIDIA. I do still have leap call options on NVIDIA. Fair value for me by the end of this year probably should sit closer to about $240 to $260 if we're just being fair here in terms of what they're doing and their status in the landscape. Beautiful accumulation period as well over the past 5-6 months. I love the company, love what they're doing. The entire ecosystem around NVIDIA will grow as well. So if you're trying to make the real big money, it's not going to be made in NVIDIA. The easy money has already been made in NVIDIA. No, you have to explore the second layers, the third layers of the entire ecosystem and become a bit more well-versed, because all these things, right, that we're going to be talking about over the next 2, 3, 4 years together, they all matter, right? It's going to be a question of bottlenecks, as you've seen with memory, right? If you want to find the big winners, you got to search for the bottlenecks, whether that's in the raw materials side, whether that's in the semiconductor equipment stocks that we talk about sometimes as well, or whether that's in energy plays that we've been referencing, you know, for the past quarter at least, right? That is where the money, but NVIDIA, it all starts with NVIDIA, right? NVIDIA is your guide. If you know they're doing well and they're pumping out the revenue and big tech is spending a whole bunch of money on CapEx, then there will be money to be made in the other sectors overall. It's going to be fantastic next 2, 3, 4 years if you know where to look, right? So we kind of have to get away from, and I'll keep covering, I mean, like we said yesterday in the themes video, right? In the themes video, what we talked about is that, yes, we can still have core positions in high quality compounders, right? Especially if you have a long-term portfolio and you really just want to passively manage it or whatnot, or if you're an ETF investor, that's perfectly fine, guys, right? But for those of you that are looking for the big returns with a higher risk profile, or you have trading accounts, right? And you're looking for the trades that are working, the trades with momentum, it's not the same trades as last year. It's not the PLTRs, it's not the SOFI, it's not the Robinhoods, right? The market has shifted. Okay, it's shifted to new names, new themes, and those new names and new themes require a little bit more in-depth research to understand, because they are more complex topics, right? They're just not as easy to get into for the average person, because the way in which they're written, you know, when you go through those earnings calls, they're a bit complex, and I'll be the first person to admit that. And I've been doing this for, you know, just over a decade right now, like 13, 14 years in the markets, right? A lot of this stuff you didn't necessarily have to know before, because a lot of the semiconductor industry previously was just highly cyclical, right? But now it's kind of all moving in a unison, so you have to know a little bit more about the intricacies of various sectors of the market. So keep that in mind. That's everything for NVIDIA earnings. Hopefully you enjoyed that. It was a lot about NVIDIA earnings, but also, you see, I spent a lot of time on the second order and the third order of things that come from the NVIDIA earnings. So please keep that in mind into the future, into this year, into next year, and basically through 2030, as we do have good visibility through there, not only from NVIDIA, but also from TSMC as well. So that's it. Now let's move into some charts, shall we? Okay, so talking first about the good old S&P 500. Well, there is a nice little daily trend change attempt right here by the bulls, looking pretty good, moving towards the all-time highs. You'll see, because of the NVIDIA earnings reaction, the futures market is down a little bit, but we just covered their earnings for like 20 minutes, so no need to reiterate. They had very strong earnings, and I do expect that a lot of various different sectors of the market will be responding very well to them. We'll see what happens with the price action, but we are still stuck in a range. Nice to see that we've now mounted above our support range again after being stuck in it for a while. 686 to 679, your line in the sand is still down below here, below the good old 678, 677 on the SPY. As of right now, no red flags, reclaiming the moving averages as well. So looking decent, but let's be honest, we are still in a massive chop zone. Just remember, your bearish narratives at play, the ones where you get news headlines from, can rock the markets a little bit, but also remember your bullish tailwinds that are currently at play, and especially this one, the good old AI megatrend, right? We know that AI is in a bit of a paradox right now. It's both supposedly in a bubble and the most transformative technology of all time, which is reminiscent of the early 2000s, of course, but we don't have the valuations that we had in the early 2000s. And this one is arguably a bit more broad, right? Not that the internet didn't help out with productivity a lot. It definitely did. But the companies this time around are far more well capitalized and trade at much cheaper valuations. So please keep that in mind. Moving on to the QQQs right now. Qs mounting above the wall of resistance, 613 to about 605, reclaiming your EMAs as well, which is a very healthy thing to do. We were on the watch for continuation of this daily downtrend by the bears. Couldn't do it, got stopped out here at about 595. And now the bulls are putting in a nice little daily uptrend of their own, nice little daily MACD cross as well, after we've kind of faded slowly over the past 3 weeks. So decent price action here on the indexes. Still a lot of ways for the bulls to kind of convert this either in the true V-shaped style recovery or the two-step weekly uptrend recovery process into new all-time highs. You are ending the worst period of seasonality for the month of February so far. The months of March and April are considerably better on a seasonality basis than January and February are, especially in midterm election years. Sorry that I don't have the chart up right now. I'll bring it up for you guys tomorrow probably in the video. So that being said, no major red flags. Red flags always come, of course, when you flush the most recent lows and you actually would head into a lower high, lower low situation, which would lend you into a further leg of monthly consolidation into the 12 EMA on the monthly, which I do believe would be the final stop. 580, 575 would be a 10% correction on the Qs. But so far, the bulls putting in some work. We'll walk through this one day at a time. Moving on to the XLF financials right now. Financials, very strong boost as well. Daily downtrend, nice little bounce right now. Better bounce than we had right here, right? So the size of the bounce on the fibs is always the most important thing to pay attention to. Why? Well, because the higher the bounce, the higher the likelihood of the bulls able to actually change the trend. That's a 618 bounce. So if you get a bit of a hesitation right here, they got a lot of room to change the trend in 2 steps. And of course, that is if they just don't want to do the big 100% engulfing move, which would be the best case scenario. The one thing though that you got to pay attention to is the fact that we've defended this support area very well. 52 down about 50. Only a couple trading days left in the week. We will see if they can print this beautiful doji candle on the weekly, protecting this support range again and try to get back above this 50 weekly EMA, which financials, to be honest with you, in the context of a nice bull market, don't really test that frequently. On the monthly time frame as well, you can see that there was a little bit of stop hunt action going on right now. We never really lost the big level that we've been paying attention to though, and we have been saying that financials overall was a very nice bid. I did put in some leap call options on XLF just yesterday. So far, they're doing quite well. But the premise of that was just because a lot of the sectors have been pulling back simultaneously, right? Taking a look at the banks all pulled back simultaneously. They were in desperate need of some monthly consolidation, and they did now receive that. You can see Bank of America, nice monthly consolidation. JP Morgan, nice monthly consolidation as well. Take a look at Goldman Sachs and things of that nature. Not too much there, but at least they got a little bit of it, right? Morgan Stanley coming down somewhat close to the 12. At least we weren't super extended all the way up here like we were previously. That's the banks. The credit cards have already had their big consolidation phases, are possibly ripe for a little bit of an upswing right now, whether it's Visa, MasterCard, American Express, and the insurance segment as well. Hasn't been doing anything for the past 2 years. So there's a lot of ways that, and we'll talk about SPGI and Moody's, the data analytics platforms, right? They've had their consolidation, big sell-off as part of the whole cloud releases in the past few weeks. And you can see that they've retraced, especially Moody's has retraced a lot of those losses so far. Basically, what I'm here to say is there are many ways for XLF to win because many of the components within XLF have sold off to very attractive levels, which makes the entire sector look quite good, especially if you couple that with the fact that you have these bullish tailwinds, most of which do favor the financial segment. So financials is still probably another one of my favorite trades. It's not tech, it's not AI, but it is a favorite trade in terms of the macro, at least in my opinion. Moving on to XLV Healthcare right now. XLV up here into resistance again, 160 down about 158. Unable to crack. I mean, the daily price action is somewhat soft. It is currently a daily uptrend, but where are we, guys? It's literally just a wide range of consolidation. Well, it's not that wide at the end of the day, right? It's only a, let's call it like a 3-4 point range. It's not too wide, but still just a bull flag. Why is it a bull flag? Because it's a monthly breakout pattern and we're consolidating at the top end of that breakout, right? So you can make an argument that the bias is still long and to the upside. We haven't really lost the weekly EMA either. So the bias for the break is definitely to the the upside. But in the event that that's not what is in the cards, well, we'll just have to look for these monthly higher lows. It would be a very healthy retrace to the 12 for possible further longs. One company that I like a lot in terms of just the price action structure right now could be Eli Lilly. Eli Lilly basically mimicking the XLV right now. Well, because they are the largest weight. So, you know, is it the chicken or the egg? Does XLV look like Eli Lilly, or does Eli Lilly look like XLV? They're the biggest weight in there. Obviously, there's more in XLV than Eli Lilly, but still, right? Beautiful accumulation zone right now on Eli Lilly. And even as we said, if the XLV breaks down and Eli Lilly breaks down as well, I'd be interested in building positions here at 1,000, down about the 900 pocket, just looking for a nice little monthly higher low for possible expansion here into 2026, 2027 as well. Company's doing phenomenal things. I would much rather buy Eli Lilly all the way up here than try my hands at taking a attempt on NVO, right? It's just more clean of a setup, in my humble opinion. Now, moving on to the next segment, which will be semiconductors. So semiconductors up 1.67%. We will see if they're up or down because of NVIDIA earnings tomorrow, but definitely a decent day here. Further breakouts through the top. Beautiful daily uptrend is maintained. The bulls are in full control right now. Many segments of the semiconductor trade are currently firing on all cylinders, whether it's some of the memory trades, either domestically or abroad. I mean, EWI, right? SK Hynix and Samsung just continue to print the highs for this industry. Obviously, the index is not entirely Samsung and SK Hynix, but like 47% of it is indeed those two names. Semiconductor equipment manufacturers, LRCX and whatnot, they're running very hot right now, but with good reason. You don't have to take the biggest ones. There are some smaller ones, which I'll eventually bring up on the channel. Memory had a decent day today as well. In terms of everything else other than SanDisk, pretty much. WDC 7%, STX 6%, and also some of the other ones. ANET having a pretty good day. That's not memory. It's just external peripherals, right, in terms of connectivity plays, right? Networking plays, etc. So semiconductors by large and by far continuing to be the market bull lead right here. You can say that this trade is extended, and I would possibly agree right now, but any pullbacks, I mean, NVIDIA just gave you the guide, right? Any pullbacks, guys, for a lot of these names are going to be buyable dips. Now, I'm not saying that we have to focus on names that are truly at extended valuations in the $1 trillion, 500, 600, 700 trillion dollar market cap range. There are smaller players across the market that we can possibly look into on pullbacks, especially some of the more in favor sectors as the market moves away from the copper trades. You've been noticing this happening, right? AAPL, popular trade last year. If they move away from traditional connectivity, whether it's this one, whether it's Credo, okay? Wall Street and the institutions, they've pivoted, right? Where have they pivoted to? Well, they pivoted to Corning. You know, they've pivoted to Lumentum Holdings, pivoted to AAOI, pivoted to Fabrinet, right? Those are the ones that are getting the breakouts right now. So keep that in mind, right? You got to pivot from copper, but copper is still going to be wildly in demand. It's just a lot of those copper plays, connectivity plays last year had ridiculous years. And I'm not saying Credo and AAPL are bad companies, right? Not at all. It's just the capital. If you look at the charts, right, you can tell the capital has kind of shifted towards the fiber optics narrative right now. Moving on to IWM Russell right now. The Russell just basically up 0.5%, but still in this tight consolidation range. So they're trying to go for the tightening up of the equilibrium range. So we will see which way this actually breaks. Those lines were absolutely terrible. So let me actually make them a little bit better here. You have a very nice bull flag, right? Very nice bull flag. Bias is obviously long because the markets do have a long bias currently, at least in my opinion. Nice bull flag, nice range of consolidation here at the highs of the move. Weekly uptrend into a bull flag. The bias does remain long. Why? Because the bulls control the higher time frames. And we obviously know that small caps have been a very popular trade this year with tons of both institutional and retail flows. So the upside is your bias right now, unless we lose the S&P and the QQQs again, at which point, of course, you could possibly crack through the lows. And if you do crack through the lows, obviously you're coming down here 250 to about 245. But as of right now, the bulls are looking good, right? No need to speculate and predict. We know the upside is a long bias. So in the event we're trying to trade this with the stop loss, stop will go probably below 258 if you want to keep it super tight, and you'd be targeting 275 breakout of the range, looking for that weekly momentum continuation. So best of luck if you're looking towards those trades, right? Moving on to the VIX right now. The VIX down about 8.28%. And it was a very hard market, right, for people trying to short the markets because the volatility was expanding. The narratives were there, crushing the software aspect of the market, crushing a lot of big tech names as well. But the market wasn't dropping because there was just too much breadth, too many small little companies holding up the index, right? So it was quite frustrating probably for shorts and even building some hedges, right? You were expecting the market to just drop and just breach through the lows because the sentiment was super bad. The velocity of a lot of the moves to the downside was very bad. The VIX was expanding. All things leading you to believe that possibly it was a very nice short opportunity. Unfortunately, not there just yet. So the VIX is currently moving down off of its 20 highs. And the way that I was playing the VIX, as I was telling you guys, was to sell options, right? Sell put options below the market on some of my favorite companies that have come down recently. And also in the event that we are in positions looking to take profit, sell call options because the call options were juiced, right? Providing some super great premium. So if you're looking to wind down some profitable trades, selling some covered calls was a very profitable endeavor as well. When the VIX is high, you do want to enjoy being an option seller rather than an options buyer for most things. Options buyer more in the short term, right? The short increase in volatility doesn't really affect leaps that much, especially if your leaps have like a year and a half of time on them. It does, but a little bit, fractionally, right? But if you're trying to buy calls like, you know, with a 2, 3, 4 week time basis when the VIX is high, you spend a lot of money on implied volatility and you just don't want to get crushed by the IV crush if the VIX comes down, right? Moving on to gold right now. So gold actually not a bad day on the Wednesday session, but not much of a move, right? Inside candle with Tuesday's action. The bulls are still looking for continuation here of the daily uptrend. Backtest location is very clear in my opinion, 5,063 if they choose to go down there, test the 12 and maybe continue on the daily uptrend. The reason we have the upward bias is because they gained the daily uptrend back after the big liquidation flush. They were actually able to mount above, create the new daily uptrend, and we're kind of back off to the races on gold. Looking good on the weekly here and the monthly time frame. Obviously super overbought, but until we start losing the secondary time frames here, guys, the weekly, you can't say the move on the monthly is done. And you can't be expecting a large-scale monthly consolidation. You know gold's been a very popular trade. I shared the statistics about the China central bank buyers yesterday, but obviously we know this trade is very popular with retail, very popular across central banks. It's a very popular trade with institutions as well, as people try to hedge against the US dollar, but also benefit from just the commodities cycle that we're in right now. Moving on to silver, same concept. Silver actually breaking through to a new daily uptrend as well in the last few days. So any movement to the downside could just be looking for a new higher low for possible further trend continuation. Looking pretty good, right? It was not looking the best for silver for a while. They were lagging behind gold, unable to change the daily uptrend. But now we actually have a beautiful new daily uptrend underway. So that being said, right, reacted nicely from the weekly 12 EMA. So if you're looking for a carry trade from just the gold structure right now and exploring the silver trade, well, if you do get a higher low, possibly down into here, into the area of congestion, which is about 82.80, entry longs could be made from here. Stop loss to go below there because the last thing you want is to get unwound. And this just turns out to be a weekly lower high and into lower low, right? That's the last thing you want. Silver's still looking good, but please, if you are trading this one, trade it with a stop loss because it's obviously very volatile. Now, moving into Bitcoin. So there were some interesting developments here in the crypto market today. So in terms of Bitcoin had a massive move today. At one point, it was up over 8%. We're tracing a little bit here, ending the day at 6%. So there was some interesting allegations. And you might have remembered, we were talking about this back in December. The algos, right? The algos, very destructive. And I've brought up these firms a few times, right? You can reference Citadel, you can reference Jane Street. Jane Street is notorious for predatory trading activity overall, and they were just caught in the headlines again today. So Jane Street faces insider trading lawsuit alleging Bitcoin price manipulation through the 10 a.m. dumps. You remember in December, we were talking about the fact that every single day at 10 a.m., no matter what Bitcoin was doing, you had a nice little pop in the overnight, you had a nice little pop at the open, and then at 10 a.m., 10:30 a.m., it was just a cascade of selling. Jane Street making a whole bunch of money, guys, almost $80 million a day, $10 billion quarters for Jane Street, right? This has to do with a bunch of they are one of the largest holders of the IBIT BlackRock ETF, and they basically leverage those and then take short positions against them using leveraged short positions in the futures markets and things like that, leveraging their large spot position into shorts pretty much and just destroying the order book every single day. So facing manipulation right now, following the lawsuit, okay, which was last night into today, you actually get a massive rally on Bitcoin. Curious the selling has subsided. And at the same time, you may think this is a conspiracy theory. Obviously, Jane Street will never admit to this publicly. I mean, maybe they'll have to in the court documents. Will have to be seen, right? Now, they deleted all of their tweets, wiped, no posts whatsoever, right after the Terraform Plan Administrator sued the firm over alleged insider trading. So the Bitcoin shenanigans, the rabbit hole deepens a little bit. Now, obviously, a lot of you noticed this. They were a big contributor to a lot of the sell-offs in 2022 as well, knowingly, right? That's a fact. The market knows that by now. A lot of this dump from October, a lot of this sometimes inorganic price action, you can thank a lot of the algorithms that now have tremendous amount of pricing power, right? So people are looking forward to Bitcoin ETFs, but unfortunately, Bitcoin ETFs have been used to generate a lot of predatory trading activity by a lot of the firms that have a lot of power and a lot of speed as well to disrupt the order flow in crypto at this point in time. So Bitcoin, a nice move off the lows, uninterrupted by any algorithms this time around. We will see if that persists, if they're able to build a little bit of a base of support. Nice engulfing move by the bulls. We were looking for something to indicate that we had a tradable bottom. This is the beginning of a tradable bottom, meaning when you have a daily downtrend like this, right, and the bears are in full control, even a bounce like this means nothing, right? You have to have at least a nice, I always reference the fibs, right? From the most recent leg of selling, right? A 618 bounce is okay, right? When you get a 100% engulfing move of the most recent leg of selling, it's an engulfing move, right? You've just trapped a whole bunch of shorts down there. You've created a new area of price action structure, and they will be looking to make a move here for some reversal long. So if we're trading this, the stop loss is now a clearly defined 62,400, let's call it, and you would be targeting upside targets of 85 to 90,000, which is the next area. Basically looking to convert this engulfing move into a new sequence of daily higher highs and daily higher lows and get a little bit of action here on the weekly time frame, a little bit of mean reversion action off of the 200 weekly EMA. So keep that in mind. That's the only short-term trade that is currently available on Bitcoin right now. You can't say it's the bottom of the cycle, of course, because they can just do something like this and then just continue consolidating, right? But there is a short-term trade opportunity off of that Jane Street news, and we will see if they turn their algorithms back on and if they just don't care, or if a lot of price action kind of gets back to a bit of a normal progression right now, because a lot of this has been inorganic, and you guys probably know it. We've highlighted it many times on the channel, right? You can call that a conspiracy theory. You can say what you want, but if you do call that a conspiracy theory, just look into the principles of, volume and just volume ignition, right? They use a lot of, you can look into Jane Street's trading practices, right? A lot of them are very, very, very predatory. They make a whole bunch of money. Most of what they do borders on the line of illegal, but, they are one of the most powerful firms in a lot of these different assets in which they play, right? So Ethereum, same concept. Tradable lows are in, 100% engulfing move in relation to the most recent leg of selling. And as a result, you do have a tradable low looking for the daily uptrend. It doesn't mean it's going to happen. That's why we play with a stop loss, right? But they are showing you a bit of a newer price action structure, at least since we've seen since the early stages of the month of January. So keep that in mind. The forward longs would be placed, and you would just be targeting your most recent levels of weekly resistance. I mean, we're below one now, right? But the actual targets, guys, for a bit of a mean reversion would be into the $2,500 up to about $2,800 range for any swing trade longs that would be attempted from here. Moving on to our big tech names overall. So Apple up 0.77%. Not looking too bad here on Apple, trying to reclaim those recent highs that we had earlier on in the month of February. Beautiful daily uptrend and challenging the tail end of the resistance area, or the top end rather, I should say. 275 down to about 267 is your range. Weekly chart doesn't look too bad. The bulls are trying to reset the weekly uptrend after having lost it here. Higher highs, higher lows, higher highs, lower lows. They got to reset the sequence of price action. That all made sense because they were going for the monthly higher lows, which have now been established into this beautiful location, which is the last area that I was telling you guys to contemplate some Apple longs. Apple is a bit of it's a contrarian trade, but not for the same reasons that you might think, right? Yes, the company is overvalued right now, but then again, if your worries are in line with the market worries, which is big tech's capex spending and things like that. Apple hasn't spent the capex overall. They still continue to do massive amounts of buybacks, and they have very nice product releases. The iPhone 17 has been very well received across China, across international markets, but also their suite of Mac Minis, which are being used to deploy Claude agents all over the place, are also virtually sold out in many locations. So, it's very funny, right? Apple is getting the lift. I mean, part of that is due to their own success with iPhone 17. Part of it is due to Claude's success and people being able to run things on Mac Minis and things of that nature. Mac Mini providing arguably some of the best compute per dollar that you can possibly find out there in just a one nice package solution, not having to build your own computer or anything like that. But the price action is looking quite good. The company's not cheap, but silly company that could be good for some smaller swing trade longs. If you're just looking to take the counter of the free cash flow cycle for the rest of big tech, right? That's the trade in Apple. That's the only one that exists, because we can't necessarily say that, oh, well, they're going to expand. They're going to go for multiple expansion here and keep up, double-digit revenue growth here for the next year or so, right? So keep that in mind, yeah? Moving on to AMD right now. AMD down about 1.39%. No specific reason for them being down today. 230 down to 215 is the overall resistance range. They had a nice pop with the meta news, but giving a little bit of that back today. So we're still trapped, right? We're trapped between two levels. You either got to mount above and give me the daily uptrend break and mount and reclaim this area. If you come right back down and fill the gap from the meta news, no problem at all. I'll continue to accumulate a little bit at AMD and play some short puts all the way down there. Thesis on AMD is still as clear as it has ever been. The NVIDIA earnings should tell you it's as clear as it's ever been. The meta news release should also tell you it's as clear as it's ever been. Forward peg ratio down about 0.89, around 210. So still very fairly valued for the amount of upside that the company could possibly have in the future. Moving on to Amazon right now. Amazon trying for the new sequence of the new daily uptrend, right? So looking not too bad, attacking the area of resistance. 216, then about 205 is that whole range. Moving on down here to the weekly, guys. The weekly damage has been done, of course. You got the good old weekly downtrend after earnings, and now as a result, you got to get it all back. It all starts on the daily time frame, daily uptrend, then you got to put in a nice sizable weekly move, get the weekly uptrend back, right? So a lot of work left for Amazon bulls, but if you're trading this one on the basis of buying leaps, 1.5 to 2 year leaps for the expansion of the business, or just accumulating shares that you're willing to hold for the next 5-10 years for this fantastic company with many amazing lines of business, whether that's AWS or their e-commerce business or their advertising business or Amazon Prime Video or their pharmaceutical business, their robotics proficiency, their Project Kuiper, right? There's just so many things that Amazon is doing very well right now. Obviously, they're spending a lot of money in terms of free cash flow for their business, but that's been Amazon's business model for the last 25 years. Nobody should be surprised. They will get good returns on investments for most of that CapEx spend. So Amazon's still one of my favorite buys in terms of large cap tech in the markets today. Moving on to Google right now. Google, not that bad of a day, 0.68%, but you still need to give me a recapture of the daily uptrend, right? Some of these companies are doing it, some others not yet, right? And Google is one of those other ones that are in the not yet category. Got to break above here the 319 highs to give me a new daily price action structure of higher highs and higher lows. And as a result, your weekly move down may just be concluded and you may just be looking to revisit the highs. Now, there's a couple possible scenarios, as always. I mean, it's very obvious, right? Either it can go up, stay flat, or go down. But what you really want to see is maybe Google consolidate, right? There's only 3 ways that they can really or 2 ways that they can do the consolidation if you're looking for the 12 EMA to catch up, because it is now extended on the technical timeframes. And in terms of valuation as well, it's a little bit extended. Earnings were fantastic, but there's only a few things that can happen, right? Either you get the actual downswing into the 12, or you just range bound sideways a little bit and wait for the 12 to catch up. Right? So both of those scenarios I'll be waiting for, because I'm not the biggest fan of positioning on Google up here. I'm a very big fan of positioning into anything under Google for Google's ecosystem, but Google itself, probably not the best risk reward trade in the market. That being said, I'm not selling any of my long-term shares. I'm just saying, like, can we make a whole bunch of money here on leap call options? The risk reward is probably not there as much as it was last year. Let's be honest with each other, right? Moving on to Meta right now. Meta 2.25% to the upside. Also one that is looking to reverse the sequence here into a new daily uptrend. You would need a break of the highs, 663, which is also the 200-day EMA, that green line right there. So we will see if the price action becomes more favorable on this company. Same time, they'll be looking to reset into a new weekly uptrend if they can claim that daily first Next line of resistance remains put at 706, down to about 682. And the valuation down here at Meta is obviously quite compelling. We've been talking about that for a while. Here, all the way through the breakdown of the 600s, if it happens, because it's on the table, perhaps, right? If the indexes just continue to be very volatile and you get another down leg of selling, 660 is a no-brainer buy for Meta. If you just want to, have a high-quality mega cap company in your portfolio, right? That's growing earnings, growing revenue at very attractive clips. I think Meta is heavily undervalued right here at a 22.4 P and a 1.17 peg. Moving on to Microsoft right now. Microsoft back above $400 with a 3% day, but no price action change. Yeah, still the sequence of the daily downtrend. Now, it's nice to see they're going for the engulfing move. Give me more follow through. Give me above this 12 EMA right here. Break above 410, 413. And we can talk about the reset of the daily uptrend sequence right there. Microsoft is really solid right now, guys. There's a few different key things you got to pay attention to, right? Number one was the bullish divergence, which we hinted at coming into yesterday on the chart. Bullish divergence on the daily. That's aspect number one. Aspect number two, Microsoft was arguably the most oversold on the weekly time frame that they have been since 2006. That was aspect number two. Aspect number three is the 200 weekly EMA, which is also consequently the 50 monthly EMA on the technicals, which never gets tagged. That is reason number three. And reason number four is because Microsoft below 400 was trading at valuations that it doesn't really trade at that often, right? Trading at very low forward 20s multiples. Microsoft also one of my favorite buys in terms of large cap, mega cap companies that you would be holding as part of a just a casual portfolio, right? Long-term investment portfolio with some mega cap tech in there. Microsoft down here at $400. I don't think there's anything wrong with this company at these current levels. Technicals look very good, and the fundamentals are, considerably cheap in relation to historical standards. Moving on to Netflix right now. Netflix up 6%. Why is Netflix up 6%? Well, now there is a lot of talk on Wall Street that it's a very good possibility that Netflix just does not get the deal. Okay, so that is the reason that Netflix is higher. Obviously, there's a lot of shareholder value destruction here while they were trying to acquire Warner Brothers Discovery. Now that the deal may not be on the table with Paramount's revised offer, which is a lot higher at around $31 per share in relation to Netflix's 27 something, and Paramount agreeing to pay the Netflix breakup fee, it's very possible Netflix walks away from this deal, right? Now, that being said, daily uptrend, these are a few different price action structures that you got to pay attention to. It's been 4 or 5 months of a daily downtrend on Netflix, yeah? Daily downtrend. They never set the uptrend here. This is not a daily uptrend. They set the highs, they never got the follow through, yeah? Daily downtrend, and most of the action was below the daily 12 EMA. What do you notice here? This is the inflection point, potentially, right? Because it's never certain, but something has changed today. Okay, you have the daily uptrend clearly, and you have finally closed a big candle, not only above the 12, but above the 26 EMA as well. As a result, your tradable low, notice I say tradable low, not absolute low, because everything is not guaranteed in the markets. But if we're looking for price action structure changes, this is definitely it. There's a few key things that lined up at the same time. Massive oversold conditions on the weekly time frame right there. Daily, reset of the daily price action, close above the 12 EMA as well. And additionally, they may not be getting the deal. So all these things combined can lead you to believe that, yeah, this may be a tradable element. You have more clarity on the price, and you possibly have more clarity on the deal not going through. That being said, the way to trade this would be your stop loss would be down below here, longs either from here, or you can patiently wait for a bit of a back test. Even longs from here are not too bad, because where are we going for, guys? I mean, you're going for the big one, right? You're at least going back to the weekly EMAs, which would be mid-90s to 100, or you're going for the full expansion. We're talking about leaps here, things of that nature, right? Leaps or building shares back into the position, right? If you're looking for a clear break, definitely not too bad. At $83, company is fairly valued in my opinion. Very nice turnaround on this chart. We will see if it actually manifests into something bigger. If not, stop loss at 75 would be the line in the sand for that style of trade, right? Moving on to NVIDIA right now. We talked about it so much in the early portion of the video. Suffice to say, if they don't get follow through in real-time market hours tomorrow, and you just get sent back down, you guys know the drill. 185, 180 is the very nice accumulation zone. You get sent back there. I will once again be selling some put options down below here and possibly buying a little bit more shares, as I do believe NVIDIA's fair value is more in the mid 200s. So keep that in mind. The chart still looks very solid. They try to go for the breakout pattern. We'll see if they can get it through earnings immediately, or if we got to pull back higher low and just go for the sequence thereafter. Moving on to Tesla right now. Tesla up 1.96%. Still no sequence change on Tesla right here. As you can see, looking for the expansion, you got to get above this resistance range. 430 down about 415 is the range that we've been targeting. We're looking for the price action switch on Tesla, so that we can confirm, all right, your weekly lows are in. The bulls have played good defense around the 405 to 385 location, and your monthly swing lows may be in as well. And you're looking for the swing lows into swing highs as Tesla develops here over the next few months overall. So no trade for me, but there is a clear stop loss area, which would be below the 386 lows right there for the monthly higher low, seeking for obviously the expansion beyond the all-time highs. Moving on to Palantir right now. Palantir, decent day worth of a bounce at about 4.15%. Now, it could have been better, but you got to take the wins as they come, right? Palantir also not showing any daily uptrend sequence changes yet. That'll be a break above 140.6, which is also into resistance. 148 down to 140. Watch for the uptrend breaks. When you get the uptrend breaks, it lets you know something has changed in terms of the price action. You then get a tradable bottom, and then you can then move to the higher time frame trade, which is recapturing the moving averages and moving closer to your all-time high area of resistance, which is 170, right? So tradable lows, not yet. You got to wait for the break of 141 if you're waiting for confirmation, right? So Palantir, not too bad down here in terms of forward valuation for longer-term investors. I keep saying it all the time. You would only buy Palantir here if you're willing to hold it for the next 3, 4, 5, 6 years, because you believe in the business model and you believe it's going to be a $1 trillion company. But the easy money on Palantir has already been made. It's a $320 billion company, right? It's not going to be as easy to make a 10x on this company moving forward than it was to make a 10x when the stock was $6. Let's be completely honest, right? Moving on to SOFI right now. SOFI up 3.38%. Nice, but still no price action structure change. You'll notice, got to change the sequence, right? So daily downtrend still. Nice move here, about a 78-80% retracement, but no claim of the daily 12 EMA. Either going to have to engulf more and give us a sequence reset, right? Or if they do it from here, got to protect these higher lows and move for the daily uptrend reset as well. As of right now, the bears remain in full control on the daily, on the weekly as well. SOFI was in oversold territory. You also had some bullish divergence similar to Microsoft. So keep that in mind. It may just be the time to switch it up a little bit. If we make our way back into the 21 to 25, it is big resistance, guys. So they're not going to be able to move through this area like butter, right? It may be a bit more challenging, but SOFI down here, not a bad pickup. If we're buying here, we have to be open to the idea of having a DCA in the event that the bears send it a bit lower into full completion of the retracement. At 19, you're trading at about a 0.96 peg and a 5.274 price of sales. Moving on to Uber right now. Uber also trying to reverse the sequence. A lot of these names are the same, right? Just watch for the daily uptrend breaks. You get the daily uptrend breaks, it's very easy. Your higher lows are set. You can actually go for some weekly expansion, targeting the most recent leg of weekly selling, right? So if the stop losses are down below there, take profits on the weekly trend change are up to 84.85. That doesn't mean the take profit's going to be achieved in 2 days. No, these are weekly and monthly swing trades, so they need a little bit more time to develop. But Uber is not looking bad. We will see if they can get it done. The bears still control. Until you get the time frame reversal, the bears still have the control. It's just how it works, right? We are reacting nicely from our support range, which is 80 down about 70. They're holding on to it with dear life. Valuation for your long-term investors out there not looking to trade it is a good time to add. Of course, it's a good time to add. They have beautiful earnings, and under 75, you're trading a very low 20s for price earnings and a very low 1 peg. And last but not least, good old TSM, Taiwan Semiconductor, 0.51% to the upside today. Very strong name. If anything, NVIDIA earnings just cement TSM's pipeline. I mean, they didn't even need NVIDIA to do that. They cemented it on their own when they gave us visibility. You might remember when we covered their earnings in January of 2026, we said they increased the revenue guidance, okay, from 25% to over 30% year over year through 2029. If that's not good visibility, I don't know what is at this point in time, right? With great pricing power. So TSM remains a most favored stock in the market right now. Beautiful daily uptrend. We will see if they present some higher low entry opportunities for more longs. But most of the longs, guys, you know me, right? Weekly higher lows. Whenever you get the weekly higher lows into the 12 EMA, that's usually been like a bread and butter swing trade attempt for TSM. So nothing for me up here in terms of swing trades. You guys know I've had TSM for a very long time. I'm keeping all my shares. I'm not adding any shares up here, nor do I have any current swing trades in motion on the company right now. That is everything that I had for you guys in today's video for the, no, not just yet, right? In terms of the overall market rundown and our, tech list that we run through. Now, let's talk about the biggest gainers and losers, shall we? Okay, so talking about the biggest gainers and losers, and while we do that, we will include some key themes. So FSLR, big solar utility producer, obviously in the United States. The reason they came down after earnings was because they had some supplier issues in Malaysia and some of their other Asia facilities. As a result, you guys know that's why I'm pretty much very heavy right now on TE Energy, just because they have the, they have the North American production facility pretty much entirely in North America by design. So since it's a vertically integrated solar producer in the US and more of a small cap, this is the solar play that I like. Solar play will be very popular, inclusively of names such as maybe FLNC for battery energy storage, such as EOSE, and your market leader, of course, of that whole pack, which is ENERSYS, ENS. Very strong battery energy storage plus solar is going to be a recurring theme, so make sure you are paying attention to it. My plays in the mix are FLNC and TE Energy for the current time being. Mercado Libre had earnings yesterday. They had very good earnings, but the market brought them down nevertheless. That is because of some underwhelming metrics. Well, none of their metrics are underwhelming. I mean, if I showed you guys the earnings slide, I don't know, maybe I can maybe I can find it real quickly here. Let me just pull up this guy. Okay, for Mercado Libre, it's very simple. I know I didn't cover earnings today, obviously just because of limited time and I'm traveling right now. I wish I could do more of these earnings, but I mean, look at this, Mercado Libre, right? Revenues, 45%, fintech, 51%, commerce, 40%, GMV, items sold, active buyers, TPV for fintech, monthly active users, assets under management. The only thing that came up for Mercado Libre was some of the credit quality, because they're growing so fast within the South American segment. And we know that South American credit is not, I mean, they're trying to bank a whole cohort of people that haven't been banked in the same way since. And New Holdings, by the way, is trying to do the exact same thing. So when you look at the demographics between Mercado Libre and Nubank in Latin America, obviously you're not going to have the same credit quality as something like in Europe or something like a North America, right? So that being said, that's one of the things that the analysts took away from this is the credit quality of their customers is not the best. It hasn't been degrading, but they did put away a lot more money for loan loss provisions, right? Since the fintech aspect of their business is growing very well. So it put a bit of a overcast on the stock. That's been nothing new, right? Mercado Libre, just because they grow more, they're onboarding so many fintech customers. Of course, they have to increase the proportion of, the amount of money they put aside for possibly potential delinquent loans. Now, the delinquencies are not the things that increased, only the loan loss provisions, similar to what you would see for whenever we cover the banks like JP Morgan and Bank of America to get a sense of what is the status of the consumer, right? So that's the only reason why Mercado Libre seemingly is down 8%. But it's not because they're not growing revenue. Fantastic company. I mean, you'd be hard pressed to find many other growth stocks out there growing so many quarters year over year, 30% plus. Still a fantastic business, still a business that I own. I'm very proud to own. It's currently at the weekly 200 moving average, which is a legacy area that we should be picking up stock if we enjoy this company. Back to 2021 highs. I'm holding this one for the next 3, 5, 6, 7 years. It's a long-term play for me, so I wouldn't let this short-term earnings volatility have an impact on a long-term thesis at all. E-commerce segment growing very fast, and the fintech business growing very fast as well. You just got to understand, right, that when you're looking at these credit metrics, you may think like, oh no, like, they have a far larger chance to default. Well, I mean, you can just look at Itaú Bank or at Santander or or even New Holdings, right? You just look at the credit ratings, the average credit rating for the average consumer in Latin America. It's never been that great, right? The purpose here is to just onboard and just take away from the legacy banks, which is what New Holdings is doing right now, which is what Mercado Libre is doing as well. So hopefully you guys understand. I know I'm going through this very quickly and I'm speaking very fast, but I'm just giving you guys, right, the pivot points for you guys to look at, or rather the crucial points of interest here for Mercado Libre. Moving on a little bit further here, we can talk about some of the neocloud providers. NVIDIA has just cemented the fact that the neocloud providers will be very popular, whether it's CIFR, whether it's APLD, whether it's CIFR, whether it's NBIS, right? Whether it's IRN, whether it's CoreWeave, they all have their little intricacies. You guys know that the ones that I have a little bit of CoreWeave, I have a decent amount of NBIS, and I also have a decent amount of Iris Energy. There's nothing wrong with CIFR. There's nothing wrong with APLD either, but just suffice to say the neocloud providers are currently stuck in the execution phase right now. The very slow and kind of quiet and boring execution phase. Last year, we got the phase where all these companies got a ton of money thrown at them. I'm showing Oracle's chart because they are also a neo cloud provider, right? But this is just the phase that we're into, right? 2025 was the big capital allocation boom. Now they're building all the data centers. So it's kind of quiet, kind of boring, right? And then after that, you actually get the revenue generation from these data centers. So everybody's looking forward to this. But not many people want to stick around through this because the stock prices aren't moving. Well, this, if you believe in the thesis, this is exactly the moment where you should be accumulating, right? So I don't mind NVIS here at these levels. You guys know me. When it popped down to 80, I was saying that is when you really want to buy it. Iris Energy, I really enjoy this company as well. From the 40s down to 30s, if we get there again. CIFR, very decent, very nice accumulation range. You know, low teens is the area of desired accumulation here. And even CoreWeave, I know they got a lot of debt, but they are directly back from NVIDIA. By the way, NVIDIA said that they once again augmented their partnership more with CoreWeave over the course of the most recent quarter. So CoreWeave is kind of in the situation where they will be too big to fail. They'll be backed by NVIDIA. I know that's not the best investment thesis, but still, I think there is a lot of upside in this company moving forward into the next few years as they currently scale their operations. And we know, I mean, with all the agentic AI layer and stuff like that, right? These neo-cloud providers are going to need as much compute as you can possibly find. So I think these neo-cloud providers will do very well over the next 2-3 years, still for some swing trade opportunities. So if you've been in these for a while and you're finding yourself lacking some patience, just remember what stage of the cycle you are actually in right now. Now, we can also talk about some other ones, such as maybe the defense names. Kratos looking very interesting, coming down here into the 80s, into the 200 daily moving average, right? 80s, 70s is an area that I would not mind picking up some Kratos. Same can be said about a company like AVAV. I've been building a position on AVAV. Next entry locations would be the low 200s. These are just drone companies, very easy plays. Whether you want to also play Ondas or something like that, perfectly fine, but you guys know I've said many times on the channel, my favorite location on Ondas would be about 9 to 6. We can even include some edge compute providers in this whole theme, right? In terms of the whole military / compute that goes into military, etc. OSS, also a very decent play, small cap play. Obviously, there's many more than that, right? If you guys aren't interested in playing these names individually and just want to go for a defense play overall, right? You can also play the defense ETF, which would be your ITA, iShares defense and aerospace ETF, right? On any pullbacks, any big weekly pullbacks of the 12 EMA, you can see they've been riding this. And there's heavy amounts of funding, right? So defense should be doing well. The only reason this one's up so high so far is obviously because the legacy defense contractors such as Raytheon, such as Lockheed Martin, such as NOC, right? And other things of that nature, they've been up at a substantial amount. So waiting for the pullbacks, playing the pullbacks on military spending, playing the pullbacks on the charts because of the high amount of military spending over the next 2 years, arguably, is a very interesting angle to be playing, right? Speaking of angles, there's a whole angle for shipbuilding and the whole marine aspect of that whole trade, right? Whether it's Huntington Ingalls for something in the more mid-cap tier range, $17 billion company generating $14 billion worth of revenue in the next few years as they have a lot of contracts coming up in terms of modernizing U.S. fleets of ships, obviously, right? A lot of military contracts, or whether you want to play something small cap like I'm in, such as Kraken direct partnerships with some of the shipbuilders, the U.S. Navy, and also Anduril, right? Which is a big player for their submarine technology. Additionally, Kraken doing the propulsion systems, right? Propellers for a lot of that stuff as well. So military is going to once again be a very popular trade. So depending where you're looking, could be a quite interesting one, all things considered. Now, I think those are some of the themes that I wanted to cover overall. We tackled energy. We talked about utilities. I'll talk about utilities again, right? We talked about uranium. URA would be a very interesting ETF if you guys are interested, rather than if you don't want to play individual names such as Constellation Energy, even though Constellation is solid. If you don't want to play Comico, which are the miners directly, if you want to play something that encompasses the miners and the energy providers, you can take a look at an ETF like URA or NUKZ. I think that these will do phenomenally into the next few years as energy remains the big bottleneck. Don't take it from me, take it from, all of the Wall Street executives that we covered, right? All this list right here. So very easy trade setup in my opinion. Copper, even though they've been moving away, even though the street's been moving away from COPX, right? These are copper miner ETFs. Even though the street has been moving away from some of the providers of cables or whatnot, right? The copper trade extends far far beyond that, right? Far beyond only the data center providers, right? There's a lot of copper that goes into the grid as well, right? So the copper trade is not only limited to names that you might find like ALAB, which are some of the end users of copper because of cable technologies, you know, names like Credo as well. Same concept, right? Copper goes well above that. I do think we showed the statistics for a while, right? There's going to be a copper shortage. It's going to be very real. Another nice bottleneck. So if you guys wanted to play COPX, you can see COPX breaking through the highs, right? A lot faster than silver has recovered, a lot faster than gold has recovered because there is a decent bottleneck here. So uranium, copper as part of the minerals trades, right? Leading into some of the bottlenecks, right? You can also talk about some of the other critical minerals. USAR is a trade that I've been building into a little bit recently with some leap call debit spread contracts, just playing the whole critical minerals trade, where you want to play this one, whether you want to play UAMY for the antimony, whether you want to play something like LPTH for germanium, which has a military edge as well in terms of what it's used for and things like that, right? So there's so many nice critical minerals bottlenecks. LPTH I do own myself as well. So there's many different key themes, many different names that we'll continue to bring up. I mean, would you rather me spend some time talking about that or spend some time talking about Nike? Right? Everybody knows the thesis on Nike, right? I've said it many times. They have inventory problems, they have execution problems, they got to get the sales back up in China. Obviously, they got hit by tariffs and whatnot. Nike trading at, you know, decade lows, et cetera, et cetera, et cetera. Sure, some of these can do well in terms of recovery stories and whatnot, but pretty sure you guys want like the sexy stuff, right? Like the tech stuff, the AI stuff, without necessarily being NVIDIA or the hyperscalers. No, like the second and third layer of plays that we're looking at, etc. Right? So rather than spending a whole bunch of time talking about Nike or, you know, talking about FedEx or talking about UPS, even though FedEx is super strong right now, that chart is ridiculous. I didn't see that it was this high right now, right? I'm not really looking to play the Verizons of the world, the XLPs of the world, even though those are very interesting. You know, Verizon on a back test right here. If you're a dividend investor, I can't forget to include you guys, right? But XLP on a bit of a back test down here. SCHD, if you have a little bit of a downswing here, the downswing on the dividend stocks will only come if XLP pulls back and XLE pulls back, because SCHD has heavy implication or heavy exposure into both of those, right? Energy on a pullback, oil and gas, very clean setup in my opinion. Midstream pipelines in relation to the data centers. I have Enbridge, okay? So Enbridge, very solid play in my humble opinion too. So keep that in mind, but mostly the dividend ETFs will only pull back if you get meaningful pullbacks in energy and XLP, which wouldn't be surprising if there is more rotation into tech. If they take a breather into some of these names, into the XLP, into the XLE, could be some nice reload areas for you guys as well. So keep that in mind. Is there anything else that I want to talk about here to the downside? I don't think so. We brought up Next Era Energy. This is part of the utilities trade. This is one that I have leap call options on as well. Next Era Energy, Vistra, could be very interesting for utilities. Duke could be very interesting for utilities, or if you don't know which one to pick and you just want to play all of them, you can play XLU, the overall ETF. The trend is gorgeous and it will probably be a very hot sector for years to come. So keep that in mind. The positioning doesn't need to be, you know, very short duration. It can be long duration positioning, and you could probably make a decent amount of money and also collect a very decent little dividend yield at the same time. Now let's move into some of the biggest winners of the day today. So if we're going to take a look here at Circle, super strong move off the lows. You know what's funny? With a 35% move, Circle is still the bottom, closer to the IPO, right? So Circle is just crypto, right? At the end of the day, if you believe in the crypto recovery story, you should believe in companies like either Circle or possibly Figure. Could be very interesting plays. Both have their own distinct niches into crypto. I'd rather play I'd possibly rather play just crypto themselves, or if we're looking to be a bit more broad outside of crypto, maybe the recovery in Robinhood as well, since they're very closely tied to crypto. And for those of you that don't believe that they're very closely tied to crypto, all you have to really do is just overlay a chart of Bitcoin and Robinhood, and you'll see it's literally the exact same thing. So please keep that in mind, right? So the reason I like Robinhood is because they're not only beholden to crypto, they do have several other ventures that they're doing at the same time. But shout out to Circle. I have a tiny little bit of Circle in one of my long-term portfolios. Nothing major by any metric, guys. It's like a $3,000 position, but you know, I have far more capital. It's just a tiny fraction of a position for me in Circle, just because I do believe in the expansion of the thesis for the stablecoin networks and all of that good stuff. Figure, shout out to them, decent play. Some of you guys will probably ask me, like, what about Coinbase? If I'm going to play Coinbase, I may as well play Robinhood, just because Robinhood has more exposure across more different lines of business for the whole brokerage industry. Right? So Coinbase is kind of in the middle. There are better brokerages than Coinbase with more wide offerings, such as Robinhood. or you can just play Bitcoin. Unless you truly believe there's some alpha in Coinbase's business, which I personally don't believe there is, it just flows with crypto flows, right? It's a leverage bet on crypto, obviously, but there's other ways to do leverage bets on crypto, such as, some of the treasuries like MSTR, BMNR, if you guys really want to, which are down below here on the list, or just playing Bitcoin itself with some lead call options, not a financial advice, but I'm just saying, like, there are other ways to play a leveraged bet on crypto, either directly or with brokerages that have a more well-rounded business model. So Coinbase is not for me, but I get it why some people want to play that. So keep all that in mind when you're building your thesis on some of the crypto names right there. I think that's almost it here, guys. I mean, we talked about AppLovin. You guys know my stances, right? Anything like AppLovin, some of those software names that have sold off recently, right? That are, well, their business models extend far beyond software, right? This is a pure play advertising play right here. Obviously, if AppLovin is a very simple thesis, right? They're advertising on mobile devices. If software and the generation of games and apps and whatnot truly becomes a commodity, you'll see just a flood of software or games or just apps, right, in the app stores. And that's exactly where AppLovin does a lot of their marketing. And obviously, if you have an influx of supply of people who just vibe code games and apps, how are those apps going to get discovered? Well, obviously, you're going to have to do a lot of advertising, aren't they, right? So who wins? AppLovin. It's just a very simple thesis. Apple wins there as well because they have the App Store. You know what I mean? So AppLovin is a very simple thesis. It's also a very simple thesis because it has tremendous operating and tremendous net margins too. Very good. Shopify is another software stock that sold off recently. I like this one down here in the lower 100s for the expansion of their e-commerce business. So Shopify as well is like a unicorn business, right? Moving on to the other ones that I highlighted recently as well that I'm interested in buying. Axon pulling back a little bit after their earnings. Super strong earnings. Axon down here, low 500s. I'm a big fan. I was a bigger fan in 400s, which is the first time we brought it up on the channel, right? Phenomenal business model, phenomenal ecosystem. They ran super hot the last few years, and now they are pulling back. And fun fact, Axon is actually in the aerospace and defense industry. As a matter of fact, it was the only name that was green today in that whole industry in the S&P 500, up 17.55% after their earnings. So keep that one in mind as well. I think that's almost everything. You guys already know my stances on Intuit and all the legacy players like Salesforce and ServiceNow and Adobe, right? I've talked about this many times, guys. I can't talk about them every single video. I'm not playing them individually. I'm playing IGV with call options for a little bit of mean reversion on the software trade. But let's be honest, right? These names just don't have visibility anymore. It doesn't mean their companies are going to go to zero. It doesn't mean they're going to fire all their employees. It doesn't mean they're going to stop raising revenues or even have their revenue growth rates slow substantially over the next few quarters, right? It's the visibility. The reason that ServiceNow is always the most expensive player, right? Even at 117, they traded a 28 forward price to earnings multiple and a 1.65 PEG. This is not a stock that trades at a 10 forward PE, even though it got crushed over 50% from its highs. It does trade expensive. Stocks that are allowed to trade expensive usually have great visibility, great predictability in earnings. These companies don't have that anymore, okay? They don't have it. They have okay visibility, but they don't have the same visibility as they had over the past 5 years. So would I put ServiceNow or CRM or Adobe in a long-term portfolio? The answer for me is no, because they don't have the visibility. Right? I can't say that in 5 years, there's not a certain aspect of ServiceNow's revenue streams or visibility or client retention that will not be disrupted. Now, obviously, we know that there's heavy replacement costs. You can't just vibe code a CRM. You can't just vibe code a ServiceNow. Everybody knows that. That's not what I'm saying here, right? What I'm saying is, what is the multiple that the street will allow these to trade at, considering the fact that they have lost some visibility into the next 5-10 years of their business model? It's very simple. There's seat risk here, right? Because companies may require less seats in the future, do these companies still have the same pricing power, right? Will they still have the same amount of licenses that will be generated on a yearly basis? And can they retain clients within the ecosystem? Not every other business is going to vibe code their own ServiceNow and do it all in-house. Everybody knows people have tried for years and years and years for the past 5-10 years build their own sales forces, to build their own ServiceNows in-house. It's very expensive to do. It's not easy to do. There's a lot of switching costs for your employees to do those. That's not what we're talking about here. We're talking about predictability of earnings. If you want these companies to trade at a 25-30 forward earnings multiple for the foreseeable future, you have to guarantee visibility. That's just how Wall Street works. I don't make the rules. So is there a good chance that these companies recover? Sure. A mean reversion trade, yes. But is there also a premise where they recover and then just stay here for a while and just don't show those massive year-over-year gains as they used to? There's a distinct possibility, and you guys need to be open to that possibility overall, right? Not all these companies will recover. ServiceNow, CRM have a lot of clients. They have very high client retention, so they're obviously in maybe a better landscape to absorb what AI has to throw at them recently, right? Or in the future, but I'm just not bidding them, right? I'd rather focus on the energy. I'd rather focus on things that have a clear thesis, a very clear thesis. And a clear thesis within software would be cybersecurity. Cybersecurity is definitely not going anywhere. Definitely not, right? They are arguably the least disruptable portion of SaaS. So as a result, if we're looking to bid software, we're looking to bid some things that have come down a tremendous amount, we can do so through the intermediary of an ETF. You don't have to buy Palo Alto, even though it's a solid company. You don't have to buy CrowdStrike, even though it's a solid company. There's many other ones. There's Zscaler, there's Datadog, there's Cloudflare. There's many great companies in the cybersecurity landscape. There's Rubrik, there's SentinelOne. So many of them, right? If you don't know which one to choose, and you don't necessarily want to pay a 3 peg for CrowdStrike, even though they are off their highs, and you don't necessarily want to pay a 2.7 peg for Palo Alto Networks, even though they're significantly off their highs. Well, maybe you make a play on the entire ETF. There's a couple different ones. There's CIBR, there's WCBR, there's Bug. They're all roughly down 20% off their highs, right? So if you just want to play cybersecurity as the whole landscape, you can do that. Or you can play those through the intermediary of IGV. IGV top holdings, the top 2 holdings are Microsoft and Palantir. Thereafter, there are a couple other companies like Infosys and ServiceNow and, a lot of the legacy ERPs in there. But in IGV, there is also a lot of, cybersecurity as well. So there's many ways to play the recovery of software. You can either play IGV and get all of them and not have to pick your ServiceNow or your Salesforce. I know playing an ETF is not sexy, but if you don't want to run the risk of choosing the wrong company that possibly gets disrupted in the future, right? Maybe you can play everything as a whole or just break it down sector by sector. Cybersecurity is one that I would not mind playing, right? If I'm looking for things that have sold off a considerable amount, but I'm not going to put my money in ServiceNow and Adobe and whatnot when there's so many other fantastic opportunities in energy and things that are just a clear thesis. Energy, utilities, things like that, right? And different semiconductor equipment and things like that, right? I'm just not going to do it, guys. The one trade has great visibility. The other one has a lack of visibility. And that's all I have to say on the matter. You guys know I'm a big fan of bidding some of these names that I also believe within the software sell-off are going to be great pickups because at the end of the day, they just get the money anyways, right? Google, like Booking.com, right? I said this yesterday. Google and ChatGPT, even though they can give you trip itinerary and suggestions, they are not going to be the agent of sale on record. They do not want to have to deal with the customer service and anything that can come thereafter, which you can deal with Booking.com directly or with Airbnb directly, and et cetera, right? They don't want to do it. Okay, Google Flights has been here for like the past 10 years. They don't record the flight sales themselves. They defer you to either Expedia or either, whatever it is, hotels.com or booking.com, when you're looking for hotels through Google Maps and hotels, right? They'll give you all the hotels. It's been like that for years on Google, right? They are not the agent of record. They don't want to do it. ChatGPT doesn't want to do it. So the revenues will still come back here. As a matter of fact, there was an interesting piece. I saved it. I should have probably brought it up. It might take me a while to find it here in my bookmarks, but give me a second here. I'll find it for you guys. And we're going to end on this one right now because I don't have the most amount of time in the world right here. So Morgan Stanley upgrades Booking.com after their earnings, February 24th. Listen to this. We think booking and the online travel agencies are set to be just as important in an agentic world as they have been in the past 2 decades. We acknowledge generative AI is going to create new products, use cases, and behavior changes within online travel. Candidly, we've been cautious over the past few years, but early agentic travel products are developing differently than expected in some ways, often diverting traffic to the OTAs' apps and websites for purchase rather than direct in-agent checkouts, while still sharing data with the OTAs in exchange to access to critical inventory. Some leaders like Google have specifically said they do not want to be the merchant of record. So there it is. The OTAs will still remain the merchant of record and still capture consumer browsing and purchasing data as key to their long-term business. In effect, we think the stage is setting up for Booking and the OTAs to remain just as critical to the long-term online travel landscape as they are right now. So it's not, you know, take that for what you will, right? So that's why I'm a big fan of buying booking. This sell-off is way overdone in my humble opinion. So there are aspects of software that I still think have a very clean thesis ahead of them. And we've talked about a few of them in terms of large caps on the channel right now. Shopify, AppLovin could be very decent. Booking.com, very decent. Cybersecurity, very decent. Legacy Mag 7, obviously, very decent. MasterCard, Visa, I don't even need to tell you guys. SPGI, Moody's, very decent, right? So you kind of got to pick your, battles, right? And there's just some battles in the market that I'm just not going to pick right now. Not with the lack of clarity surrounding them. Some other ones, you can clearly see through the bluff immediately. Some other ones, not so clear. And I will leave you guys on that because now the video is about an hour and a half long, as they always are. So that's it for me today, guys. So once again, focus on the key themes. Yes, if you want me to go, yes, Broadcom indeed is very solid right now. Broadcom is arguably a buy. American Express is a buy. Uber is decently a buy. JP Morgan down here is indeed a buy for financial swing trades as well, et cetera, right? I'm not going to go through each name individually. Hopefully just with the themes and how I talk about different themes and how I structure the thesis and the thought process. Hopefully that's enough for you guys to be able to then look into the names on your own and be able to, because I can't cover all the 200 something 50 names in this watch list. It's just impossible, right? I'll go over the broad themes, some of my favorite plays, how I'm approaching those themes and plays, and hopefully you guys can also drive the same if you're interested in something that I haven't mentioned in the current video. And by the way, Bloom Energy is solid. Just Bloom Energy is a very solid pickup, especially after this consolidation range. Looking very, very nice breakout. Bloom Energy for the next couple of years. Very, very, very solid. It plays into the fuel cell conversion technology from the gas turbines, such as something like from GE Vernova, or from new players in this whole niche, which are something like look at this chart right here, FTAI, which basically they just repurpose old jet engines from Boeing 737s and things like that, from scrapyards, just like old planes that are not in circulation anymore. They repurpose the jet engines to power for the data centers, right? As now we know with Trump's State of the Union the other day, and just today formally announcing that big tech will have to bring a lot of their own power online. So if that's the case, we'll think turbines and, you know, solar and things of that nature, right? They'll have to generate their own power and not maybe plug into the existing grid for everything. So you got to look into these styles of plays, right? So keep that in mind. Yeah, but that is now everything for today's video. Hopefully you guys enjoyed. If you did, consider dropping a like. Put a lot of work and research into these videos, so hopefully you enjoy them. If you like them, consider subscribing as well. We'd love to have you back on the channel. And last but not least, if you had any questions, comments, or you're looking at certain plays, definitely feel free to share them down below in the comment section. Take care, guys. Pleasure as always. I'll see you tomorrow after the close. Peace.